I want to welcome everyone to this FMA virtual panel. I'm Kristine Hankins from the University of Kentucky, and we're going to be talking about the U.S. government's economic response to the pandemic. I am thrilled to introduce our panelists today. It's an amazing group of people that were really at the heart of policy making during the crisis that has been so recently affecting all of our lives. And so what I'm going to do is take just a few minutes to give you the brief background of our four esteemed panelists. Then I'm going to give them each 5 to 10 minutes to talk about their accomplishments and challenges while they were facing, in their different roles in the US government, the response to the pandemic. I have a few questions queued up that I'm curious about for the panelists, and I'm going to encourage them to also banter back and forth, ask each other questions, piggyback, feel free to participate however they wish. And then at the end, I'd like to have some Q&A from the audience, and hopefully we'll have ample time to do that as well. So that's the plan for today. Okay, so let's start off in no particular order. I want to introduce our four fantastic panelists. So first we have Tyler Goodspeed. He is the Kleinheinz Fellow at the Hoover Institution at Stanford University and the U.S. Director for Greenmantle, LLC. From 2020 to 2021, he was chairman of the Council of Economic Advisors, having been appointed a member of the council in 2019. In that role, he advised the administration's economic response to the coronavirus pandemic, as well as subsequent economic recovery packages. He previously served as chief economist for macroeconomic policy and senior economist for tax, public finance, and macro, playing an instrumental role in the design of the 2017 Tax Cut and Jobs Act. Before joining the council, he was on the faculty of economics at the University of Oxford and was a lecturer at King's College London. He has published extensively on financial regulation, banking, and monetary policy, and received his BA, MA, and PhD from Harvard University, as well as an MPhil from the University of Cambridge, where he was a Gates Scholar. Next is Charles Calamiros, who is the Henry Kaufman Professor of Financial Institutions at Columbia Business School and Professor of International and Public Affairs at Columbia. He recently served as Chief Economist and Senior Deputy Comptroller of the Office of the Comptroller of Currency. He's a member of the Financial Economist Roundtable and a research associate at MBER. His research spans banking, macro, corporate finance, and financial history, in addition to an impressive record of publishing in the top journals in finance and economics. His prolific output includes books such as Fragile by Design, published by Princeton Press, and Reforming Financial Regulation After Dodd-Frank, published by the Manhattan Institute. He currently is working on a book entitled, and I love this, Useless History and the Future of Banking. He received his BA in economics from Yale and a PhD in economics from Stanford. Next up is S.P. Kothari, who is a Gordon Y. Billard Professor of Accounting and Finance at MIT Sloan. He has an incredibly impressive range of senior executive experience in government, academia, and industry, and most recently served as Chief Economist and Director of the Division of Economic and Risk Analysis at the U.S. Securities and Exchange Commission from 2019 to 2021. He has worn many hats before his tour at the SEC. He was Deputy Dean at MIT Sloan, served as the editor of the Journal of Accounting and Economics. He was Global Head of Equity Research for Barclays Global Investors. He's been a director of the Bombay Stock Exchange and currently serves on the boards of Velen Studios and Ebex Cash. He received his BS from Birla Institute of Technology and Science, an MBA from the Indian Institute of Management, and a PhD from the University of Iowa. Last but not least, and one of my favorite co-authors, is Mike Bothdander, who is the Dean's Professor of Finance at Maryland Smith. He joined Maryland in 2008 and was Associate Dean of the Master's Program since 2017 and 18, leaving that role to serve as Assistant Secretary for Economic Policy at the U.S. Department of Treasury. During the COVID-19 pandemic, he assisted in negotiating the CARES Act and was a senior treasurer official who led the implementation of the Paycheck Protection Program. In January, he was awarded the Alexander Hamilton Award for Distinguished Leadership, which is the highest service award by the Department of Treasury. His academic research lies at the intersection of financial economics and public policy. He's been cited in top academic journals, received many best paper prizes, and has been cited in the Wall Street Journal, New York Times, and others. Before joining the faculty at Maryland, he also served on the faculty at the Wharton School, at the Kellogg School, and the Oldham School. He has a PhD in finance from Northwestern and a bachelor's degree from the economics of UC Davis. Now, hopefully that will be the most you hear from me today, besides a few questions peppered in here and there. But what we are all here to do is to hear from our amazing panelists. So I was thinking we could start off with SP, who was in the SEC at the time, and he could tell us a little bit about the capital markets response and what the Securities and Exchange Commission was doing at that time.
Thank you, Kristine, for that flattering introduction. I joined the SEC in 2019 March, and things were quiet and calm and quiet. Everything was going well, at least in the economic market side. And then all hell broke loose with the onset of COVID-19. I will relate another story. My previous foray into the world of securities markets was when I joined Barclays Global Investors, and they were managing about $2 trillion, and they asked me to be the global head of active equity, and that portfolio was a couple $100 billion. But my timing was not quite right. I joined on July 1, 2008, and then all hell broke loose over there as well. So jokingly, I say that, how do you manage $100 billion? Well, you start with $200 billion and then you lose $100 billion. So that's what jokingly I say. But there was that deja vu moment when I came to the SEC, and then in 2020, in early March, COVID-19 pandemic hit, and things went haywire for a moment, at least a short period. US equity and debt markets, they were over $80 trillion when the COVID-19 pandemic brought the US economy to a screeching halt. The stock market declined precipitously in March 2020, and corporate bond ratings experienced downgrades that were never witnessed before. Trading in the treasuries experienced stress. The commercial paper market came to a grinding halt, and some money market funds, especially institutional money market funds, experienced redemption challenges. Treasury prices declined, spreads widened, and basis traders were experiencing losses. REITs were also attempting to deleverage, and they were having some difficulty selling off their MBS securities. The rest of the world was experiencing similar problems, since the COVID-19 was a global pandemic affecting economies in every part of the world, either directly or due to interconnected nature of the world economy. Now, where does the SEC fit into all of this? Well, of course, SEC oversees all these securities markets, so it directly had an effect. But the SEC is mainly a regulator, not a policymaker. So we discussed internally what was transpiring in the market and the integrity of the market functioning and continuous trading taking place, or smooth functioning of the market. That was the primary concern of the SEC. And so we were keeping track of what was transpiring in the market and where there were severe challenges. And our role was to communicate that information and statistics daily to the Fed, to the Treasury, to Financial Stability Board, the ECB, IMF, and Bank of England to some extent. And so those are the entities that were entrusted with making or taking policy actions. In the US, the White House, the Fed, and the Treasury collectively made those policy decisions in consultation with the SEC, CFTC, FHFA, FDIC, and I'm sure the Commerce Department as well. What happened by way of response, at least my understanding, and Tyler and Michael and others can correct me, but there was the immediate purchase of the treasuries to the tune of $1 trillion that was instrumental in lowering interest rates by about 1% and raising prices, asset prices. The liquidity infusion as a result was helpful in restoring confidence and thus lowering the spreads and increasing trading in the marketplace. So that was one thing that happened. In hindsight, the market might have overreacted in lowering equity values across the board. In March alone, I think the prices fell by about 30%. This was the steepest drop in equity prices ever experienced in the US. The government's actions in providing generous unemployment benefits, eviction moratorium, and the Paycheck Protection Program to help businesses preserve organizational capital with the use of federal funds, all of those things helped the US economy to cushion the blow of COVID-19. And in my opinion, two additional factors helped the economy. One is remote working performed better than anticipated. There was real doubts in people's mind whether the technology would survive and whether people would be, corporations would be as efficient in performing their activities on a remote basis. But I think the whole economy operated better than anticipated. And the second is what I label the substitution effect in people's activities and spending behavior. The fact that economic activity as we saw it in terms of the roads where there were no traffic, there were no cars, no restaurants were open, but that didn't stop people from watching perhaps more movies or doing some other things. So there was, or renovating their kitchens and remodeling many other parts of the homes. So there was that substitution effect, which in my opinion was bigger than what might have been anticipated if we had just been asked, well, what would happen if the entire economy comes to a screeching halt, or at least the more visible segments of the economy come to a screeching halt. And that helped the spending continue, and the market clearly rebounded. And in one of my commentaries, I said when the market initially went down, to borrow from Shakespeare, it was like the tempest. And then when when things started to come back up in April, it was much ado about nothing. And then when things continued to rise, then I said, gee, it is more like Midsummer Night's Dream. And then when they continued to rise further, then we all thought that taming of the shrew is called for, and that it was getting rising a bit too much. But overall, lower interest rates and continued economic activity, notwithstanding the pandemic, resulted in a very robust stock market rebound and improvement in debt markets starting in April 2020, and that we are witnessing that is continuing even now. So that was, so part of it was response, part of it was how the economy responded, or people responded to the pandemic, and thereafter the vaccines coming in effect. All of those things, I think, contributed. And the SEC, I thought that we, as well as folks at the Treasury and at the Fed, as well as White House, didn't panic, and that was quite helpful. That kind of stoic response to the pandemic, I think, went a long way in restoring confidence and bringing people back into action. Let me pause here. Sorry if I took too long, but
no, that was perfect. Thank you so much. I think at this point, we'll turn it over to Mike if you want to talk a little bit about your work with Treasury and PPP.
Sure. Thanks, Kristine. So I was part of the team that was working with Tyler and working with the White House to determine what the fiscal response was going to be to the pandemic. And as SP indicated, we needed to move very quickly. And I would argue that the main problems that we were trying to simultaneously solve were to keep households liquid and solvent so that they could comply with stay-at-home orders. The thought was, if people are concerned about their ability to put food on the table, then they're not going to stay in their homes and be compliant with the best practices from a public health standpoint. So we needed to make sure that paychecks kept flowing and that people could access their financial savings. We also, to the extent possible, wanted to keep workers attached to their employers to mitigate skill degradation, because the thought was that if the pandemic is brief, we want to be able to realize a V-shaped recovery, and therefore we wanted to try to reduce as much as possible any reductions in skills. We also wanted to realize whatever economic production could be safely generated. As SP said, I think we were all positively surprised by how effective teleworking was, but we really wanted to encourage employment at whatever level of productivity could be realized, as opposed to moving everybody onto the unemployment insurance system. And then I think one of the most kind of underappreciated objectives that we had was to reduce the burden on the state unemployment insurance systems. I don't know how it is at a lot of your universities, but at Maryland, whenever the central campus tells us we can't do something, they justify it as saying, well, that's because our registration system is still on COBOL. Well, that's the system that most state unemployment insurance programs are still based on. And so there was exceptionally limited capability to ask the state UI system to do much. I also remind people regularly that the week that the president signed the CARES Act, 6.6 million Americans filed first-time unemployment claims. To put that number in perspective, during the worst week of the financial crisis, it was around 800,000. So we were looking at people accessing a system that doesn't scale and that's built on 1960s computer architecture that we were very worried about was going to break. And so as we're analyzing what can we do to solve these problems, we generated 3 criteria for evaluation of different fiscal policy options. First and foremost was it had to be timely. This was the 3 T's: timely, targeted, and temporary. And the most important of those was that it had to be timely. The question that we constantly asked and that we were pressing lawmakers about was, whatever outcome you come up with, can we implement it quickly? As I said, when you've got millions of Americans filing for first-time unemployment claims, you can't come up with a system that's going to take months in order to implement. We needed something that we could roll out in days or weeks. And so if you look at the Paycheck Protection Program, for instance, we rolled that out less than 1 week after the president signed the CARES Act, because we were able to put it on top of existing architecture. The second thing was, to the greatest extent possible, we wanted it to be targeted. We didn't want to create unnecessary windfalls. The problem, of course, that you have is that when you're looking to implement something quickly and you have a choice between making sure that everybody's needs are met, recognizing that some are going to be overmet, versus the alternative of trying to reduce windfalls, but in the process, leave some people behind. Unfortunately, the bias was towards being too generous rather than being too thrifty. And then the third criteria was that it had to be temporary. Our view was that the economy was in great condition heading into the pandemic. There were few, if any, immediate structural imbalances prior to the pandemic. The pandemic was the end of the longest economic expansion on record, and we had a 50-year low in the unemployment rate. So our objective at the time was to revert to a strong economy once the public health challenge passed. And so we insisted that all pandemic-related programs have sunsets. And the thought was that if the sunset proved to be too short and the pandemic potentially lasted longer than was anticipated, we could always go back to Congress for more money and for an extension. But we certainly did not want this to be an excuse to permanently increase the scope and scale of government. And so the package that we ultimately negotiated was the CARES Act. It had 6 elements: the Paycheck Protection Program, which I'll talk about in a minute. We had the economic impact payments. So these were the $600 payments that went out to households. There were enhanced unemployment benefits. So this was the $600 per week boost for those that did go onto unemployment. There was a payroll program for the airlines and other national security industries. There was money allocated to support the Federal Reserve facilities. And then there was also direct aid to states, municipalities, and tribes. And so what Secretary Mnuchin did is he broke those 6 pieces up into 6 groups at Treasury. and he asked me to take the lead on the implementation of the Paycheck Protection Program. So working directly with the Small Business Administration, the idea was to utilize the banking system to keep paychecks flowing. So small businesses would take out forgivable loans that were the equivalent of 2.5 months of their average 2019 payroll. Borrowers could then use the proceeds on payroll, mortgage interest, rent, and utilities. And under the CARES Act, they had 8 weeks to use the money. And we insisted through rulemaking that 75% of those proceeds go towards payroll. In later legislation, Congress did create additional forgivable expenses. They extended the covered period to 24 weeks, and they relaxed the payroll percentage down to 60%. The other thing the CARES Act did, though, with regard to PPP, is that it called upon Treasury to add non-bank lenders in order to expand access to the unbanked and the underbanked. In a typical year, approximately 800 lenders participate in the SBA 7A loan program. By the time PPP closed in August of 2020, when it closed for the second time, we had brought in more than 5,400 lenders. So there was an enormous, and that was not just traditional financial institutions that are overseen by a financial regulator, but it was also addition of numerous fintechs. So originally, $350 billion was appropriated in the CARES Act. In 14 days, we exhausted that. And again, just to put that $350 billion in context, that's the equivalent of 14 years worth of SBA lending. So we did 14 years of traditional lending in 14 days. In late April, that was increased to $660 billion. We estimated that the program was going to require less than that, which is why Treasury had only requested a total of $600 billion. And when it closed in August, it was a total of $525 billion that had been lent. In December, Congress approved a second round of loans, and it brought total program authority up to $806 billion. And so before, President Trump signed that on December 27th, and then we were given 10 and 24 days respectively to get the various elements implemented, which happened to perfectly correspond to Inauguration Day. So on January 19th at 10 o'clock at night, I was signing a rule so that we could have the second round completely implemented and all of the updates to forgiveness done at the time of the inauguration. So with that, I'll stop, and then we can get further into it if there are questions during Q&A.
Fantastic. Thanks, Mike. Tyler, can I ask you to go next?
Sure. And I'll try to share screen here. Can folks see?
Yep, got it.
Okay. Right. So I think, first of all, reflecting back on the experience of the pandemic, one of the things that is easy to lose sight of is the magnitude of the shock that hit the U.S. economy in 2020. So the OECD in early 2020 were projecting that GDP would decline by 12.2% during the 4 quarters of 2020. And there were private forecasts that the unemployment rate would peak to as high as 25%. And remain above 10% through the end of 2020. So in terms of magnitude, we were really looking at the biggest macroeconomic shock to hit the U.S. economy since 1932. And as Mike said, our thinking was motivated in large part by 2 realizations. One is that this was expected to be temporary. We were told 2 weeks to flatten the curve, but I think there was a recognition that it would probably be longer than that. And also that unlike in 2008, U.S. factors of production, labor, and capital were probably on the eve of the shock, for the most part, efficiently allocated. So we wanted to, as much as possible, try and preserve both those high-quality employee-employer matches and also some of the organizational capital that's embedded in firms, particularly small firms, because once those matches are severed, once that organizational capital is lost, it can take time to reconstitute, and all the while, goods and services markets are going to be operating at less than full capacity because of those supply side dislocations. Mike touched upon the sort of overarching themes, sort of going into a bit more of the details. You know, on the household side, I think we were very much motivated by the realization that at the end of the day, 70% of the US economy consists of consumption. And so 22 million Americans becoming unemployed all at the same time potentially blows a huge hole in 70% of the US economy. And there are sort of two ways you can respond. One is via income replacement, one is via cost mitigation. We ended up doing a combination of both, but by and large, income replacement, it tends to be more efficient. And we did that through several means. Mike mentioned the enhanced federal unemployment insurance benefits. This consisted of the $600 per week top up, which, as Mike pointed out, was intended to be temporary. It was originally slated to expire on July 15th. That was subsequently extended at a lower replacement rate, lower top up rate under executive action, and then again at an even lower rate in the December 2020 COVID relief package. But also to make sure that we are plugging gaps in the traditional unemployment insurance system. So workers who otherwise wouldn't have been eligible, gig workers, the self-employed, workers with limited work history, other types of workers who otherwise wouldn't qualify, to make sure that they were covered. And also, you know, the idea was we want to make sure that the income replacement is at a higher rate than just the standard 50%, because again, we're talking about 22 million Americans becoming unemployed at the same time. And as Mike pointed out, a lot of these state UI systems operated on very old IT and couldn't handle sort of a 100% replacement rate. They had to do lump sum. We also had the economic impact payments that Mike pointed out, and some of the motivation here was just the relative velocity of economic collapse versus the creaking state UI system and its ability to get money out. I mean, we saw in March of 2020, several state UI systems basically crashed because they were not equipped for the volume of claims that were being filed. And the economic impact payments, $1,200, so $2,400 for a couple, plus $500 per child. This was actually more, this was first of all bigger, but it was also more targeted than the economic impact payments in 2008, 2009, because we preserved the same phase out threshold. So in inflation adjusted terms, these were actually lower phase out thresholds. And unlike in 2008, 2009, these economic impact payments went out regardless of whether you had earned income or not. So this was certainly targeted more toward the lower end of the income distribution. We also wanted to make sure that fiscal policy, as Mike pointed out, that fiscal policy was supporting public health objectives. So one of the big things that we did in the CARES Act, in the policy package just before the CARES Act actually, was emergency paid sick and medical leave. So basically private employers with fewer than 500 employees were eligible for refundable tax credits for costs associated with providing paid leave for COVID-19 through the end of 2020. And that could be funded in advance but with funds already deposited at the IRS. So this was basically to make sure that if you were sick or you had a sick family member, that you were able to take the necessary leave to take care of those folks. And then on the cost mitigation side, we had mortgage, student loan, rent, and tax forbearance. And I think in retrospect, and we can see it in the data, in retrospect, given the success of income replacement, I think an argument could be made that maybe the cost mitigation wasn't necessary, or certainly the extension of some of these provisions well into the economic recovery was perhaps unwarranted. In terms of business provisions, Mike mentioned, of course, the PPP, which he has a great study out that suggests that alone could have saved as many as 18 to 19 million jobs. In addition to that, we rolled out an employee retention tax credit that again that provided a refundable tax credit against payroll taxes for employers that either were required to shut down because of COVID or suffered at least a 50% drop in year-over-year revenue. up to, so it's a 50% tax credit up to qualify for qualified wages up to $10,000. There was also a deferral of the employer side of payroll tax liability, and also a modification for net operating losses, which I think is one of the underappreciated elements of the CARES Act. So basically, if you had a net operating loss, which a lot of firms did in 2020, that was a tax asset that otherwise firms would have, if they survived, would have been able to carry forward to future tax years. We said you can now carry that net operating loss back to get a refund for 2018 or 2019 taxes paid, when presumably a lot of these firms were profitable. And so this was a big boost for firm cash flow during a period of extreme shock to firm cash flow. And from a budgetary perspective, it wasn't as costly as some other provisions, because again, these were always going to be NOL, these were always going to be tax assets in the future, even if the firms became insolvent and became bankrupt, because they would have become tax assets under liquidation. And then there were economic injury disaster loans, one of the many liquidity facilities that were stood up, and some SBA debt relief. And please, Kristine, do tell me when I'm trespassing on the time.
You're good.
But I think when we're looking at the evidence on this, I mean, it was a very substantial immediate impact when a lot of these provisions were stood up. I mean, you saw it in the initial claims data, but we also see it here in the income replacement. So this shows so here we see the effects of the economic impact payments and enhanced unemployment insurance benefits on household income by income percentile. So without these provisions, a household at the 10th percentile of the income distribution would have experienced a 10% reduction in income in April 2020 compared to its February 2020 level, and remained 7% lower through August. So instead, what we observed was household income at the 10th percentile was 127% higher in April 2020 than it was in February 2020, and still 7% higher in August. And the effects are even more pronounced if we look only at households that were experiencing employment loss. So a low-wage household earning $500 per week with 2 children would have experienced a 50% reduction in income in April through August 2020, but instead experienced a 240% increase, tapering to a 10% increase in August 2020. So this was a really substantial income replacement at the lower end of the income distribution. We can see it in the aggregate data as well, that this was, I think, the first U.S. recession where personal income, monthly disposable personal income, actually went up because of those enhanced UI payments and the economic impact payments. And actually by early summer 2020, we saw retail sales actually rebound to their pre-COVID levels. On the business side, I think we can see the effectiveness of those NOL provisions, PPP, on measures of bankruptcies. So this is just a vector autoregressive forecast of small business Chapter 11 filings using lags of unemployment insurance claims. And for most of the sample, as you can see, the model forecasts track actual filings pretty closely. But in 2020, we saw filings rise by 28% compared to a forecast. We saw bankruptcy filings, Chapter 11 bankruptcy filings rise by 28% compared to a forecast of 182%. And there have been some recent NBER working papers that also find some pretty big residuals from forecasted filings, which can't be fully explained by court closures due to COVID or other policy uncertainty. And then just finally, from a bigger picture macro perspective, I mentioned up front that the OECD were projecting that the US economy would contract by 12.2% during the 4 quarters of 2020. They're projecting that the unemployment rate would remain in double digits through the end of the year. And I mean, instead, what we observed was the unemployment rate peaked at 14.7%. It was down to 6.7% by December. GDP, the decline in GDP was mitigated to 2.3%. compared to 5 to 10% in most other advanced economies. And even if we take the broadest measure of labor market underutilization, so-called U6, it includes marginally attached workers, people working part-time for economic reasons, that had declined by the end of 2020 to 11.7%. That was actually a lower than it was as late as August 2014. So sort of 5 years into the preceding expansion. So I think there are legitimate debates to be had about type 1 versus type 2 errors. But I think in terms of the magnitude of the shock that we were facing and the effective mitigation of it, I think that there was a lot to learn from the economic policy response to COVID-19.
Absolutely. Thank you so much, Tyler. Let's move on to our last panelist, but certainly not least, Charlie Calamares.
Thanks, Kristine. I'm going to try the video. I'm not sure if it's going to work because I'm up in the mountains. So if the sound isn't working, please let me know. If you can't hear me, then I'll just turn the video off. Okay?
Sounds good.
Great. It's a pleasure to be on this panel, and I particularly enjoyed the prior presentations. When I came to be chief economist at the OCC in the middle of 2020, it was to join Brian Brooks, who had just been named just before that acting comptroller and an old friend of mine and a very high energy guy. And Brian had a lot of very ambitious ideas he wanted to achieve, and which I think he succeeded in achieving, particularly having to do with new chartering of fintech-related financial intermediaries within the national banking system. It's a great theme to talk about. I want to emphasize he was hitting the ground running during COVID with this initiative, and we had a lot to do. I had about 110 people working for me in economics, most of them PhD economists. And that was especially interesting because while we were setting up a new strategy for economics, which was rebuilding pretty substantially when I came in, nobody was available really to meet with in person. So it was all done online. It was very challenging. And then we had a comptroller who had a very heavy and high energy agenda. And for the economists, it was particularly interesting because we had to help design prudential, regulatory, and supervisory standards for these new kinds of intermediaries, which was really fun. And we had our own little mini Manhattan project on how to think about prudential regulation of intermediaries that don't have big balance sheets. So that would be a lot of fun to talk about, and the challenges of working with people you've never met before, where you're meeting them online only, which is with 110 people. Coordinating that was really pretty weird, I have to say. But it's a testimony to the quality of the OCC economists that they really managed to pull it off, I think, quite well. But the main thing I wanted to talk about was not just, our new initiatives and our coordination of our strategy, but how we responded to COVID. And I want to emphasize the word uncertainty. Our job as the supervisory agency of the national banking system is we have to have a sense of what's the condition of the banks and what are the problems on a forward-looking basis. And the uncertainty that COVID brought was really unprecedented because the thing nobody knew was how long this crisis was going to go on for. And how it would affect the banks, of course, depended on how it affected bank borrowers. Businesses, we know many businesses were forced to shut down. And of course, many consumers faced a lot of challenges. And the policies we just heard about from other people on the panel were highly uncertain in terms of their impact. We didn't know exactly how it was going to play out because this had never happened before. And furthermore, there was a substantial amount of uncertainty related to the real estate market. Banks in the US, about 3/4 of their loan portfolio is real estate related. And there was a lot of concern that as tenants, meaning commercial tenants, experienced shocks, that banks would be faced with a non-payment of substantial amounts of their loan portfolio. And I will just be honest and say, we didn't have, and I haven't seen anyone who had a really good working model of how COVID would be affecting real estate delinquencies in the commercial real estate market in particular, which is just crucial for our banking system. You might even say commercial banks are largely real estate banks, really, in today's world. So that was a big problem because it was all about the duration. We didn't know the vaccines were going to be coming through. We didn't know a lot. Furthermore, if you looked at the OCC's research capability, it was organized where, in terms of modeling, everything was done one loan category at a time. So people in our risk analysis division, some were working on credit cards, some were working on mortgages, some were working on various kinds of commercial loans. But there hadn't really been, they were all doing their research kind of, in separate silos. And there wasn't any existing kind of overall picture of the entire loan portfolio by bank, right? So putting it all together and trying to think in which regions and which kinds of banks would be experiencing on a forward-looking basis problems. That didn't really exist. And so I organized immediately about 35 people to work on using their existing skills on the particular loans to put together a forward-looking picture. So instead of just looking at what happened in the past, which of course they were all doing in their research, to actually take the macro forecasts and integrate them and using forecasting models from each loan category, then create a sort of overall forecasting picture of the banking system. And I'm very proud of what the staff was able to do. And we really did that as another kind of little mini Manhattan project. And within 4 months, we had a working model on a forward-looking basis for every bank, that we regulated, which means we were able to use, based on different macroeconomic scenarios, what a forecast of non-performing loans would be for every one of those banks. And of course, another problem was we didn't know how things like foreclosure moratoria or other kinds of policies would be affecting the performance of the banks. So we were able to forecast, given the macro scenario, what the non-performing loan situations would be. But that was under a normal kind of regulatory environment. And so we had to then also project, after doing the modeling, how things like the foreclosure moratorium and other things would affect the outcomes. But I think we were able to basically come up with worst case scenarios and understand pretty well, based on each of the particular macro forecasts, what were the possible outcomes. And what I can tell you is that through this process, I was surprised that the predictions were fairly favorable. That is, as we were, I wasn't sure when we started the project whether we would end up seeing a major banking crisis as a result of COVID. I think it's quite reasonable to think that we could have had one. The policies that were put in place that were described by the other panelists, it did turn out it worked quite well. But exactly how they were going to filter through and exactly how the real estate market was going to play out, although we were trying to track it in real time as best we could, there really wasn't a very good model of that. And so until we built this framework, I think it's fair to say that there was just huge concern and uncertainty. So one of the big positives that we got from developing this framework was that we were able to see, certainly by, let's say, September or October, that we weren't going to have a major banking crisis. It looked like, especially if we had any kind of reasonable timetable for ending the crisis, if we knew the crisis would end by, let's say, March, we were pretty confident that that meant that we would have a nice outcome for the banking system. And that was very reassuring. And then, of course, once the vaccines were developed so quickly, that really added even further to the assurance. But I want to emphasize, I didn't know that was true in July, August, and even early September of 2020. I was quite concerned. And so why did it work out that way? Well, of course, it's already been mentioned, the government policies were quite effective. Also, the banking system was starting from a historically low non-performing loan ratio, which was good luck for us. And also we had the foreclosure forbearance, and a lot of landlords were kind of working things out with tenants voluntarily in a very reasonable way. And the banks were working with the landlords in turn in very reasonable ways. So I was able to, as things evolved, on my last day at work, I was able to share our presentation. We now have a quarterly forward-looking presentation that the OCC does that forecasts hotspots in the banking system based on macro scenarios. So that's something that was the result of the COVID epidemic because it made us have to develop that toolkit. And I was able to share it with the Treasury Department in, I guess it was March, as part of one of the last things I did with the new Biden Treasury team coming in. And I think it's especially helpful to be able to give them a sense that the banking system was not about to explode. And that, so I think there was a very happy tale there about developing some new tools that helped us be a little bit reassured. And I think I'll leave it there.
Excellent. Well, thank you so much. These are all really interesting things to comment on as far as different angles that you had perspectives on during this crisis. But I think one of the broad themes that people really are walking away with is as much uncertainty as there was, that now we can all play Monday morning quarterback because it ended up fine, which is amazing. And we can say, oh, did we spend too much, or would we have designed this policy in a different way ex post, knowing what we know now? And I think there are lots of questions that can be asked, and hopefully will be today. But I think it is an amazing reflection that the response was so swift and immediate to such an unprecedented event, which leads me to my first question. A lot of the immediate response was channeled through sort of the Section 13.3 ability of the Fed to extend credit and equity to lots of different parts of the market. And yet now ex post, people are thinking maybe we want to limit the ability to use this tool. Is that something that you think makes sense, knowing what we know?
So my view is that, yes, it should be limited and it should require, I think that our negotiation in the CARES Act that the funds only be there through the end of the calendar year was an important initiative on the part of the Secretary, because as we said, this is a temporary crisis and we should only deploy extraordinary tools for very short durations during the crisis. And by the end of summer, as SP talked about, we had seen largely a recovery in financial markets, and it was completely appropriate, therefore, to bring these facilities to an end. Can
I ask you just to push a little bit on that statement? I did find a letter where the Secretary and Powell jointly authored that said that there didn't have to be a term limit on the CARES Act, the restrictions of using the Section 13.3 lending programs.
So there's a limitation on the ability of Treasury to provide funds for it. So there's two different pools of money. So there's the permanent funds that are in the Exchange Stabilization Fund that the Secretary can deploy, and in fact did deploy prior to the CARES Act. Then there was additional money outside of the ESF that Congress deployed that was only available through the end of the calendar year. So it is the case that the Secretary, that the Federal Reserve Chairman, in consultation with the Secretary, can have these facilities go on, provided that they use ESF money.
Yeah, so obviously I'm not into all these details in the way that everyone on this panel is, but sort of there have to be a window before, if we had another emergency, where we could roll this out again?
Maybe this is a bit naive, but as a general principle, it seems to me that we want to have Congress to provide the authority. And only, in the interest of efficiency and coping with some unforeseen, like the pandemic or something, in the interest of efficiency, some latitude for the Fed or the Treasury to take certain action to cope with the calamity. But as a general matter of principle, I think it should be Congress they are the ones we have elected. Otherwise, there always is the danger that bureaucrats might usurp some power and they might conjure up, say, oh yeah, this is an emergency, or cater to what the White House is saying. So it seems to me that it should be, I like what Michael said, that it should be timely, targeted, and temporary, the reactions or actions. So.
Well, thank you. To follow on, just one more question about the capital markets. One of the most successful parts, I don't know if we can rank which is most successful or not, but this was the Fed's first foray into the corporate bond market and supporting that market with the primary and secondary corporate credit facilities. And at least from the academic evidence that I've seen is basically that people find that to be a resounding success. The cost of trading eligible bonds went down substantially when these programs were announced, as there was a positive impact on the ability for firms to raise funds when they were constrained from the equity markets. So for the first time out, that was considered great, but people are now wondering if we've created moral hazard, or if we've created sort of this idea that we not only have banks that are too big to fail, but are we also bailing out the investors in large firms? And is that the right way to set this up? So how do we balance those perceived success with potential costs down the road?
So at the time, the Fed did come with a check of about $1 trillion, I think. And they bought treasuries, and then they started buying also corporate bonds. And a lot of on the street, people were saying, oh, the markets were frozen and the spreads were increasing and they wanted liquidity. But the reality is, amount of trading that was taking place, even without the Fed, it was at all-time high. And yeah, the spreads were a little bit higher. There's no question about it. But that is a natural consequence of uncertainty. I think the Fed buying, what it did was to lower interest rate by about 1%. And there were also a lot of cry about, oh, basis traders, they were losing money or something. And I said, how much are the basis traders, their investment? Maybe $500 billion. And suppose they lose 2% on that, that is $10 billion. I mean, why do we have to bring a checkbook with $1 trillion to save for the basis traders $10 billion? So that cannot be the reason. The real reason was that interest rates, which came down by about 1% as a result of enormous intervention by the Treasury or the Fed and buying so much of debt securities in the marketplace and creating that demand and lowering interest rate, which had some ripple effects. So those are all good reasons, but a lot of the success that gets talked about, which is about the frictions or liquidity and those things, and to me, that was second order.
If I can speak to the moral hazard piece, the way that we thought about it at Treasury was it would create moral hazard if it was as a result of firms' actions that they made themselves susceptible to shocks in the first place. That by bailing them out, you would encourage them to do it again. This shock, was not. This shock was very different than, say, the tech bubble or the financial crisis. It was not a result of agents in the economy doing bad things and then we were bailing them out. It was a completely, idiosyncratic shock that had nothing to do with bad decision making. And I think, as Charlie said, the banks were in a very strong position going into the crisis. We weren't seeing a bunch of imbalances, and therefore we weren't looking at it as, bailing out a bunch of bad behavior. In fact, if anything, I thought that the bailout of bad behavior that has taken place has been some of the later pieces of legislation that bailed out things like pensions for both multi-employer unions as well as for states and municipalities. That, I think, is the much bigger moral hazard that came out of it. But I don't think that we really had that in the CARES Act.
Tyler, do you have anything to add on this one?
Yeah, so I mean, I think Mike hit the nail on the head in terms of the bigger picture institutional issues. I think from a purely policy perspective, there's also the question of using the right instruments and the right treatments. And there's no doubt that I think income replacement at a large scale made sense in March, April, May 2020, to an extent that it doesn't necessarily make sense 8 months into a recovery, in 2021. And the provision and stand up of emergency liquidity facilities makes sense in March, April 2020. The continuation of those emergency facilities doesn't necessarily make sense, and they're treating. And it amounts now, the continuation of emergency fiscal and monetary policy provisions is very much treating demand side problems that are no longer manifest, and using demand side tools to try and to try and fix what are today supply side problems. So I think it's important to bear in mind, are the instruments, are the tools that we're deploying appropriate for the illness that we're trying to treat.
Thanks, Tyler. Well, that brings up a really interesting sort of segue into a big picture question that I've heard people talk a lot about, which is sort of the intent of the stimulus package, the direct transfers, as well as the magnitude of the UI support. And sort of, Tyler, in your initial comments, you sort of said, okay, we're looking at consumption, we're looking at income replacement, but also Mike pointed out this is to have people comply with stay-at-home orders. So I'm wondering sort of what, we had 3 series of stimulus. We've obviously had UI up and continue up. What do you think what was the original intent? Was it to keep people at home? Was it so they're spending? But then also, how does that match with kind of the magnitude? I guess I've seen a recent MBER paper that said the median replacement of UI was actually above the average income. And so sort of what was the goal there? Was that kind of just like, that happened, whoops, this is the fast way we could get it out? Or was that the purpose? Let's get money out and hope people spend it.
Right. So I think in terms of the supporting the public health objectives, this is why, as I noted in the Families First Act that preceded the CARES Act, that provided emergency paid sick and medical leave, so that folks who otherwise didn't have access to paid sick and medical leave, folks who tend to be on the lower end of the income distribution, they could take that leave if they needed to. In terms of the unemployment insurance benefits, there's existing infrastructure there, sort of like with PPP and the SBA. There's existing infrastructure. This is a very fast moving shock. It gets the funds out to households at a time when 22 million households are experiencing employment loss. I think there were, without getting too much into the details of negotiations on the Hill, but there were disagreements about amount. And certainly we flagged, Mike over at Treasury and CEA in the executive office flagged that the $600 a week supplement took the replacement rate above 100% of prior income for something like 70% of employees. I think in the context of April, May 2020, that probably didn't have a substantial impact on return to work because most places were still closed, firms weren't hiring, and that's why we negotiated for a sunset to that. And why the lump sum? As I said, our preference was for a replacement rate between 50 and 100% of prior income. Something more than 50%, because otherwise 22 million Americans losing work that's going to be a big blow to 2/3, 70% of the US economy. But those
certainly gonna
IT
show up in
systems.
Charlie's bank issues as far as real estate delinquencies and things like that, right?
Yep. Yeah. And then you could, because then you can have cascading issues, that people start to default on student loans or on mortgages, and that cascades through the finance. So you get these financial transmission mechanisms. So generally speaking, rather than trying to play whack-a-mole, with this cost mitigation, that cost mitigation, try to do a good job at income replacement.
No, it's fascinating. It's so interesting to just hear not only sort of your perspective on what happened, how it happened, sort of the speed, but just building on the infrastructure you had in place and how that was absolutely necessary to facilitate the implementation. And one thing that people have talked about is the PPP loans. And this has obviously gotten a lot of coverage in the news, but also in academics. Like, I think generally the assessment, it has a positive impact in employment, and people have wide-ranging estimates of what that is. But there's been more mixed evidence on sort of PPP access. And one of the things that was part of the design was kind of the first come, first serve. And Mike, you talked about this being sort of a targeted program. Do you think that first come, first serve was ex post something you would have reconsidered, or do you think that really was the way to go?
I think it was absolutely the right way to go. Our view was that if the program is fully funded, then we should fulfill requests as soon as they come in. We needed to obviously take steps to bring in as many lenders as possible. And so we were working day and night all throughout the Treasury to review the applications of the fintechs that wanted to enter into this space in order to obtain better access for the unbanked and the underbanked. But I don't think that delaying getting money out to stronger small businesses would create much of a benefit. Whether it was a job at a well-financed small business, or it was a job at a small business that had difficulty accessing funds, those were still jobs that we were saving, and we were relieving pressure on the unemployment insurance system. So our thought was, we want to get out as much money as fast as possible to everybody that is eligible, and let's just make sure there's enough money so that anybody who's eligible can obtain their full loan.
Well, I appreciate you bringing up the fintech issue, because I think one of the recent papers I've seen by Sabrina Howell and a couple of co-authors looked at, well, there have been some concerns over access to PPP loans, whether you had a banking relationship, there were some race issues, but they found the fintech lenders were ones that were able to, there was less discrimination or less barriers to access for PPP. And so that allows me to pull in Charlie back into the conversation, because I know fintech is really kind of a passion project of his, and the regulation of fintech. And so I was hoping you could talk a little bit, Charlie, about sort of what you were doing in the OCC, either with True Lender or charters and the fintech market.
Thanks for asking, Kristine. Actually, there was a huge amount that was going on in fintech. I mentioned the need for the economists to set up our own group to advise on prudential regulation. That was one piece. But another part of it was interfacing with the Consumer Protection Bureau, I forget what it's called, the creature of Dodd-Frank, on trying to get them to also understand from a consumer protection standpoint how important fintech was for inclusion. And that also was informing very much our views, and I should say the views of the last 4 comptrollers. It's not a partisan issue at all, of how crucial it was to think in terms of updating the national bank charter to allow these institutions to get some kind of national bank identity, which would allow them to operate throughout the country without having to have licenses in every state. So I really want to emphasize, we had a group in economics. People who are trained more in the tools of labor economics when they were hired by the OCC to look at inclusion issues. And we had a group of about 8 economists who were specializing in fintech. And we wrote a report and internally, and then shared with a lot of different presentations to the Consumer Protections Bureau, what our findings were very much along the lines of what you're saying. That is, fintech firms have much greater flexibility in the way they think about credit risk. They've developed new tools for measuring the credit risk of people who aren't covered by typical FICO score kind of information. They also have new techniques to reach out to people in small dollar loans that are more favorable than typical payday kinds of loans, and also in terms of payments technology. So whether it's on the lending side or the payment side, there's no question that it was really crucial to, it is crucial for us to push to include fintech firms in our formal banking system. So I don't want to go on at great length because it is a passion project for me and also for Brian Brooks. But I think that what we saw very much was that, there's something, tens of millions of underbanked or unbanked people in the United States. And of course, they tend to be people who, are poor, were very heavily hit by COVID. So I think it's not a surprise to me at all. I saw that study that you mentioned. It wasn't a surprise to us at all. This was something we were communicating to people in Washington at the time. I will say that I think that this is under severe threat right now, because, and I really want to emphasize this, and there's a political coalition opposed to fintech. It's not just the incumbent banks, it's also the Federal Reserve Board and many influential members of the Democratic Party. And I'm not trying to be partisan here, I'm just talking facts. And there really is the upheaval that will happen for the incumbent banks and for the Federal Reserve, which is very creative, good kind of upheaval, is something they're resisting. And they've gotten a lot of partners in the Democratic Party. So the president's got a working group coming up on thinking about cryptocurrencies and fintech. And I'm not optimistic about what's going to come out of that right now. I think that we have to be pushing back pretty hard on the fact that the politics and the economics of fintech are diametrically opposite. The economics are all about progress, efficiency, inclusion, and progressive changes in the payment system and the lending system that will benefit everyone, especially low-income Americans. The politics, you might be surprised to hear, is going to be pushing very much in the other direction.
Mike, did you have something you wanted to add to that?
Yeah, if I can add to that, I think one of the most important things that Charlie just mentioned is the cost structure at the fintechs, that there are costs to underwrite. They've been able to realize greater efficiencies than traditional lenders. And, the fee structure for loans in PPP was a percentage of the dollar amount of the loan, which meant it was uneconomical for very small dollar loan amounts to be issued. And that was why, because you normally would think about modeling underwriting costs as mostly a fixed cost as opposed to a variable cost. The cost of the source of funds has got a variable cost component to it, but the actual origination is more of a fixed cost. Fill in the loan amount, whether it's $500,000 or it's $5,000. And so the issue they have is that the fintechs were able to get their loan costs down and therefore serve smaller loan amounts better than some of the traditional banks. And I think that is one of the most important things that the Howell and co-authors paper really talks about, is that the lower cost of origination for them puts them in a better position to serve some of those lower income communities where it hasn't been sufficiently profitable for traditional banks to realize entry.
Okay. I could just go on for a while with more questions, but I think it would probably be a little more fair if I open this up to the audience for Q&A, or to the panel if you want to ask each other questions. Let's see, do we have anybody jumping in?
Well, someone jumps in, may I?
Please, go ahead, SV.
I have one question. I do
okay,
research in firm financing decisions, and there was an impact of the financial crisis on the patterns that were going on at the time, that firms were generally reducing the amount of debt that they had coming out of the financial crisis, is the way I would phrase it. Would you expect in 2020 and 21, you would see an increase in firms' reliance on debt financing as a result of this? And how long do you think that will go on?
SP, I think you were talking about this before the panel started. So do you want to refresh on some of that?
Sure. I think that interest rates are historically low, and firms' profitability has been pretty good. So their interest coverage ratios are, as Mike earlier was mentioning, interest coverage ratios are really quite high. And that naturally, if you take an individual, if there is salary, how much mortgage do they get? And the banks also apply, well, certain percentage of your salary. If that's the amount of, if the interest is certain percentage of salary, then whatever that interest will support that debt, that's the amount of debt that they have for a mortgage. And if you apply the same logic to firms, when the interest rates are lower and the profitability is where it is, naturally they would be able to assume more debt. And that's what we are witnessing. So it all hinges on what is the trajectory of interest rates. And also then if interest rates suddenly rise and if that affects profitability, that might be the double whammy and they might get in trouble. But barring that, I expect firms to continue to be highly leveraged for next year or two.
Thank you.
Do we have any more questions from the audience? Yes, Demetrius.
Hello, Kristine. Thank you very much for this interesting session that you have organized. Thanks also to the distinguished speakers. I would like to ask, of course, getting the point of Professor Kothari, if you believe that the interest rate should increase over the months to follow, because there is a lot of discussion on this, or do you believe that they have to stay stable?
Others might have different views, but as I look at it, the budget situation is such that they are wedded to low interest rates. It's with $28 trillion of debt. Now there are questions about how much is external versus internal, all those things. But nonetheless, if you add couple percent interest rate, then that is $400 to $500 billion of additional budgetary costs. So in some ways, I think the government is handcuffed to low interest rates. Now, of course, the Fed and others, they can do only so much to tame interest rate. It is the market forces that determine. So it would be interesting to see what happens. There are so many economists who are continuously perplexed by the fact that notwithstanding the economy doing quite well and inflation being high, interest rates still remain low. And I genuinely think that this is a puzzle that many economists haven't been able to solve. But in the long run, it seems to me interest rates are going to go up. Whether that long run is within a year or two, I don't know for a fact. I wish I knew it. I could be rich, you know. So, but that's where I will leave it at that.
I want to jump in here if I can. I think that what Mr. Kothari just said, I think makes a lot of sense. Interest rates, real interest rates, have been declining globally for the last 25 years. And economists have really not come up with very good explanations. Some of it's demographics, some of it may have to do with the change toward intangible capital in the production process. There are lots of theories out there. If we don't know why it fell, that means we also don't know whether it might come back fairly abruptly. And I wouldn't be at all surprised if the demographic explanations turn out to be the right ones. And that means it could be a sort of generational reversal that we're going to see over the next 10 to 20 years. And I want to emphasize this is a global problem of potential debt overhang. In corporate debt borrowings in all around the world have been going up, especially for people in dollar-denominated corporate debt markets outside the US, and especially with very large denomination bond issues, which tend to be part of the indexes and enjoy a big liquidity premium. In some research that I've done, we found. And so we're seeing corporations that never would have thought of borrowing $500 million worth of US dollar debt all over the world doing that, because that's included in the SENBI narrow index if you raise 500 million. A lot of them are still holding cash 2 years after. The smaller companies that are reaching are holding cash maybe 80% of the proceeds of what they borrowed. So it's a little hard to know what the financial risk is if the companies are borrowing hugely, but then also maintaining cash. So that's one of the things I think we as researchers need to look at, because a lot of these companies who are borrowing more than they need for current purposes because of the market opportunity. So we have to kind of look at the net leverage position of these firms too. So I think it's a research opportunity that hasn't really been fully exploited.
So if I can just add on top of that, one of the things that I was reminded of when we would work on the Social Security Trustees report is that we've not hit peak baby boomer retirement yet. So as Carly said, if this is being driven largely by demographics, and yes, it's global demographics, not just the United States, but the peak years were 1957 and 1960 for births, which means those people are just turning 60 or in their early 60s. And that means that we've got a few more years before we see all of them go from being net savers to net spenders. And so will that keep interest rates low? And of course, the problem you've got is, does that mean that exactly when we've got peak retirement and peak deficits in Social Security and Medicare, that's exactly when we get the interest rate reversal?
All great comments. Anybody else want to jump in?
I was talking to the S&P. I'm sorry, if someone wants to have a question, then by all means, we should go with that rather than me kind of.
I'm sure people would love to hear what you're going to say.
I love hearing you opine, SP. Go on.
I was talking to S&P debt rating folks, and that individual was particularly interested in Medicare related. And I said, in your projections, have you factored in that several 100,000 very old people have died, unfortunately, as a result of COVID? But the flip side of that is that the medical expenses associated with last 2-3 years of life of very old people, all of a sudden we have a reduction in the number of those individuals. So I'm not trying to therefore justify anything here, but just purely from a financial standpoint, purely from making a forecast, Medicare may not be in as bad a shape as we previously thought because of the unfortunate number of deaths that have taken place among very old folks. As I said, this is a little morbid kind of way of looking at it, but if I were to look at it just purely in terms of dollars and cents, that's at least this impact is going to be non-trivial.
Well, so let me add on to that. I chaired the trustees working group. That was part of my roles at Treasury. And I got to be careful because not all of this is public, but the original thought was both Medicare and the Social Security actuary put out exceptions, if you will, in their annual report, because when we came out with the trustees reports in spring of 2020, it was too early in COVID to really know what the impact was going to be. We hadn't modeled it out. Later in 2020, both of the actuaries came out and said, this is going to be a shock that is likely to take a couple of years off of the trust funds. But then interestingly, for Medicare, as you were just saying, SP, the trustees report that eventually came out earlier this year, that finally did the analysis and incorporated all of the impacts, showed that there was almost no effect on the solvency of the trust fund. because while payroll tax receipts were down and there were some additional Medicare expenses associated with COVID, remember who's most susceptible to COVID. It's the people that are that have compromised immune systems and are undergoing expensive treatments. And so again, not to get morbid, but if those folks die of COVID in days rather than months of their previous ailment, that is less costly to Medicare. The big uncertainty with Medicare is what are the long-term health impacts of being afflicted with COVID. And that's the piece we just don't, at least when I left, the last briefing I got on it, we just didn't have enough insight into that yet.
Yeah. And the other uncertainty, of course, is the entitlement keeps changing. It's a sort of moving target, right? That we are adding more benefits. And I'm not saying that is good or bad, but just from a financial standpoint, the more benefits that you add, there is going to be increased consumption of those medical services that will increase the price tag on Medicare. So the net effect, yeah, it's interesting to see what happens on balance over time.
Well, I have everybody here. We have a few minutes left, and I would love to get your input as far as, let's hope this never happens again, but if it does, what did we learn? What would be the go-to tools that you take away from the government's economic response to this pandemic that could be used to another shock? Is it the direct payments to businesses? Is it, or direct stimulus payments, higher UI? Mike?
Well, I'm going to change your question and say, what do we need to do so that we're better prepared the next time? And I would say we need to fix the state UI systems.
Yeah.
I mean, if we really could have implemented percentage income replacement rather than flat dollar amounts, I think that we could have. I think that we could have been more targeted, and I don't think we would have had to kind of have committed some of the generosity errors that ultimately occurred because we had to do a lump sum amount, and the lump sum had to work for the median worker and therefore was too generous for a lot of people. The problem that you've got, and to their credit, the Obama administration tried to improve state unemployment insurance systems following the financial crisis, and hardly any states took them up on it because states didn't, they had to put in matching funds. And so, so will states spend money in order to make their system more effective and therefore more costly? Or did they actually like that the clunkiness of it meant that they got more generous outcomes than they would have from the federal government? So I actually think the federal government is going to have to be the one that fully pays for updates to state UI programs, state UI systems, if we're ever going to have a system that has the capability we need it to have if something like this happened today.
Yeah, I think Mike raises some good points, and I suppose one caveat I should say is that it's difficult to, it's perhaps we ought to be cautious extrapolating from this crisis to others because of the uniqueness of this crisis. So while work sharing or efforts to maintain employer-employee matches was very good and very successful with this crisis, to a certain extent in other types of crises you do need to have some reallocation of people and capital. But I think, yes, the speed of the response and helping to preserve that organizational capital and those employer-employee matches were positive lessons to be learned. I would say one additional lesson that I learned is the inability of the vast, sprawling federal public health bureaucracy to respond effectively to a fast-moving crisis. I mean, we at the Council of Economic Advisors, I think someone's phone is going off.
Yes.
Mr. Mohanty.
To respond to a fast-moving crisis. So we at the Council of Economic Advisors found ourselves having to provide the task force, Dr. Birx, with real-time data from the laboratories, the testing laboratories, Abbott and Roche and others, because they were unable to find someone in the sprawling public health bureaucracy to simply map the location of high-throughput testing machines and to monitor capacity utilization of those machines. And a lot of the lesser known response of the federal government was actually getting rid of or temporarily removing a lot of the bureaucratic impediments to an effective policy response. So we were concerned, for example, about strains on healthcare capacity. So we relaxed scope of practice rules to allow nurse practitioners and other professionals to ease the burden on doctors. We relaxed rules on PPE, or personal protective equipment, so that PPE previously produced and codified for industrial context could be used in medical context. We relaxed the rules on telemedicine so that people wouldn't have to be overwhelming healthcare facilities with non-COVID health issues. And basically every one of the advanced therapeutics and the vaccines that emerged in 2020 were emerged and were made available through emergency use authorization. So a lot of I think the unspoken effectiveness of our response to this crisis was temporarily removing a lot of these bureaucratic impediments. And that's something that I don't think gets much attention, that we have this sprawling, very dated federal bureaucracy that just isn't designed to respond effectively to a rapidly evolving economic or public health crisis.
Just to add a small point, the other thing that from a modeling standpoint, and of course we were interested in trying to model the condition of the banking system, and the most important question was, as the duration of this crisis proceeds, how on the margin, how will that affect bank health? And we didn't really have any prior evidence that was really highly relevant. We were using things like experiences in hurricanes and other kinds of things that were very local to talk about these kinds of sharp, extreme things. And we knew this was different because the thing that was different was it could continue. You know, the hurricane happens and it's over. Going forward, modelers will have the experience of COVID. And I just can't emphasize how huge that is. They'll also at the OCC have a brand new toolkit, which wouldn't exist if it weren't for COVID. So I think that Tyler's points and Michael's points are very well taken about how really, I think next time policy can be a lot smarter, assuming that we have a government that wants it to be. And I think, you know, there really is a lot of that's kind of permanently and positively changed from what we've learned. But certainly just from a modeling standpoint, think about all the macro and banking and other people who are modeling sort of the effects of this kind of a crisis. They really had nothing to go with in any recent data. And, you know, it's a big advantage looking forward that we can, you know, use what we learned.
Well, I have to say, this has just been absolutely fascinating from my perspective, kind of getting to look under the hood of how this all got rolled out so quickly and successfully for the, you know, overwhelming part without having the toolbox of the prior knowledge of we've seen this before, and yet it all managed to. Markets kept functioning, household incomes were up, people maintained jobs. And so this has just been really interesting to hear everyone's experience, as well as the challenges and how they would sort of evaluate in the future the government moving forward to deal with, hopefully, the next crisis in the far future. But thank you all panelists for your time. This was very, very interesting.